So, good morning, Julie.
Morning.
Hello. For anybody who's watching this, I'm Andy Martin, and I'm talking to Julie at Rawlins Davey about inheritance tax this morning. So, Julie, my first question is, surely inheritance tax is a financial matter rather than a legal matter. So, why do you need a lawyer?
Oh, that's a really good question. Thing is with inheritance tax, it's a tax that's charged when you die, but whilst you're alive, you can try and maximise the allowances and exemptions that are available to your estate. So a solicitor can help you plan ahead with your will. The will is the key thing that can really help maximise the allowances and exemptions available to you.
So, I guess it's important, therefore, that there are two sides to the equation. There's the legal side and there's the financial side, and they come together to get this sorted out, I'm assuming.
Oh, absolutely. I mean, I always say to my clients, you need an inheritance tax dream team around you, and that includes not only a solicitor, but a good accountant, good independent financial advisor, and they will all tie in the elements together to help you and your estate get the benefits of these IHT reliefs that can help them pass your assets on to your beneficiaries.
Okay, that's good. Thank you. And so just explain in layman's terms, what exactly is inheritance tax and who's liable for it?
Well, inheritance tax is tax charged when you pass assets to others, either whilst you're alive or when you die. And your executors, when you die, are responsible for working out what your estate is, so what you own and what you owe, and then working out what tax needs to be paid on that estate to the government. So it is down to your executors then to look at what you've gifted in your lifetime, because that's also taken into account, and also if there are any allowances or exemptions available to reduce the tax bill on your estate.
Okay, and what sort of numbers are we talking about then in terms of, when do you become liable for it?
Well, we've all got our own allowance. So we've all got an allowance. And I don't know why they give complicated jargon when it applies to everybody, but it's £325,000 is our nil rate band. So if we see that as a building block, all of us have our own building block, £325,000 worth of allowances before IHT is then calculated on the assets above that amount, which is 40%. So we've got this £325,000. Some estates will benefit from a further building block allowance called the residence nil rate band. And that's a relatively new allowance in terms of inheritance tax. And again, this is where really special planning whilst you're alive could potentially utilise that allowance and bring your allowances up to £500,000. And then over that amount, it's taxed at 40%. That's a simple calculation.
Okay, so I gather there are some very important things called exemptions and allowances. So can you explain the difference between, how do those two things work?
Oh, well, exemptions mean that your nil rate band is £325,000 when you die. Your executors look back and see if they can add that full amount to your estate. Now, if you've given gifts away within 7 years of your death, the taxman casts that back into your estate, and that can chip away at your nil rate band allowance. So what we have to do is advise our clients on how they can utilise the inheritance tax exemptions that are available for their gifts. So, for example, we've each got our own gift exemption of £3,000 per year. I could give £3,000 to one of my friends if they needed a bit of a cash injection for something, and that wouldn't chip away at my nil rate band. So £3,000 per year in total, not per person that you want to give it to. We've got the small gift exemption. So I could give £250 to every single one of my neighbours if I wanted to. And that wouldn't eat away at that nil rate band allowance. I could give money towards weddings I could give £2,500 to a grandchild for their wedding. I could give £5,000 to my child for their wedding, and that wouldn't chip away. And the really careful one that people can overlook, if they've got capital and they've got a nice healthy income stream, they can give regular sums of money out of their income, but only if it doesn't affect their standard of living. So, for example, say I've got nice investments working well for me, I'm living off the income, I'm living the dream life, and I don't need it all though. And then I think, well, my poor stepdaughter's suffering at university, she's in London, she has no money, I could give a regular top up to her from my income, and that wouldn't reduce my nil rate band, but only if my executors can prove that. So a good accountant, good record, good statement of where your income is coming from and how you are spending it are crucial for your executors to really keep your nil rate band in place.
Yes, I was just going to say, it seems to me that if you're going to do any or all of those things, you have to be very careful in either you documenting them or an accountant documenting, so you can prove what you've given and why you've given it.
Exactly, and even if you can't do the gifts out of income, just trying to work out if someone's gift exemption per year can be quite complicated, because an executor looks back 7 years. They've got to prove that those gifts you made meet these exemptions. So careful statements, even a receipt from the person you're giving the money to, all filed together. We all like nice tidy folders in the law world, so keep all your admin and your paperwork together, and a good accountant will be able to keep you up to date on where you're at with these gifts.
Great. And are there any other key points that are worth making about inheritance tax and how to utilise it?
Absolutely. I mean, people talk about giving property away whilst they're alive. Again, they could do that. However, there are certain things that we've got to be careful of. It will be brought into that net for the calculations within 7 years. And also, there are really technical points where it could also fail as a gift. And that would be if you're still living in the property, if you're still getting a benefit from anything that you've given away, then HMRC could disregard that gift, and then it doesn't meet the purpose. Also, there are other things that can be done whilst you're here, such as planning business property relief. Family firms can be passed down for the generations without inheritance tax being calculated on them. If you've got some capital you want to invest, maybe you can invest in unquoted shares in other companies, startup companies, for example. That is where a good independent financial advisor could tell you where to invest your money. And as long as you've owned those shares for 2 years before you die, then they could benefit from this beautiful business property relief and IHT exempt.
Brilliant. So just 2 final questions. First of all, what's your most important piece of advice to anybody who hasn't made any inheritance tax planning? So that's the first thing. And the second thing is, and I probably know the answer to this because I'm talking to a lawyer, but is your first port of call in that situation the lawyer or the financial advisor?
Right. Well, definitely at the moment, hot off the press, it's all about the residence nil rate band. So people don't quite understand how they can reach their maximum allowance. Now, the government, as part of the manifesto, brought in they were going to bring inheritance tax allowances up to £1 million, which they've kind of done. But as long as you are leaving, married couples are leaving their property to direct descendants, children, stepchildren, grandchildren, does not include brothers, sisters, nieces, nephews. So go see your solicitor, have a will review. Most solicitors are quite happy just to go through your will, explain where you're at. If things don't need to change, then great. If you need to just do a few tweaks and make sure your allowances can all be put in order and maximise the value of these assets passing to your beneficiaries, it's quite a simple process to do. So will review to try and maximise your residence nil rate band as well as your nil rate band for all these other gifts. Secondly, yes, I mean, I would say either or. Go see your solicitor. They will have in mind, we can't give financial advice. So over to a really good independent financial advisor. We work closely with them to make sure that the will reflects the reliefs that are available, where the investments are being put. If you go see your independent financial advisor first, I am pretty confident most of them will say, right, first thing first, get your will sorted. Let's have a chat with your solicitor to make sure that the standard reliefs are available, and then we can look at lifetime planning.
Great. Lovely. Well, I think that will probably cover us for now. So thank you for some very useful information.
That's
I might
okay.
even cover that myself.
Well, yeah. Don't get me started on income tax yet. We've got income tax, capital gains tax. We can cover the lot.
Yeah. Well, income tax next.
Yeah.
So can't wait for that one either. So thank you very much.
That's okay. You're very welcome.